Hey everybody, it's Reed, and I'm joined here again with Lisa Hutton. We are continuing on our Construction Accounting 101 series. Just a quick disclaimer up front, this is not financial advice, so if you do have specific questions that are related to your company's financials, please reach out to your CPA or qualified professional. Today, Lisa, I think we're talking about cash flow statements, right?
Correct.
So what the heck is a cash flow statement, and why is it important to a business?
Yeah, so a cash flow statement is a statement that shows the change in your cash from one period to the next period. So for example, if I want to see where my cash went for a year or a month or a quarter. So basically what it does is it helps beyond a balance sheet and profit and loss, it helps illustrate why my cash changed and where my money went, right? So cash is king. We hear that a lot in the accounting world. So I, as an owner of a construction company, would like to know, where did that cash spend go? So that's basically what a cash flow statement does, generally speaking.
So we're not just looking at the cash flow statement, we're using it in conjunction with some other reports, right? I think that's kind of important to point out.
Yeah. So when you look at a cash flow statement and you look at your balance sheet and profit and loss, those are kind of like the three key financial reports. You want to make sure that your certain numbers tie to each other. So you've got net income, you've got cash, and all three of these have different amounts, different, like net income is on a couple of them. Cash is on a few. You want to make sure they tie to each other, right? You don't want to have cash reported differently on one statement versus the other, for example. So
now, cash flow statement, not to be confused with cash or accrual accounting, right?
Correct. So cash or accrual accounting. So cash accounting on your balance sheet would be, I've got cash and equity. Accrual accounting is I've got some assets like receivables and payables, where when I receive that money in the door, when I receive a bill in the door from a vendor and I have not paid it yet, I still owe that. That's accrual accounting. Once I pay the bill, cash accounting records it when you pay the bill, for example. So cash flow statements or cash flow balance sheets are a little more, are simpler. However, they don't paint the full picture. Some people use them because their tax return is a cash basis, or they don't care, they're small enough. They would rather see ins and outs that way. Accrual basis just gives you a little more information.
Makes sense. Well, maybe let's dive into a cash flow statement and see what we got cooking.
All right, so I'll share my screen here. So what I have displayed here is a cash flow statement for an entire year. So as you'll notice at the top, I've got a cash flows from operating activities section here. I've got a cash flow from my investing activities section, and I've also got cash flows from financing activities section. So there's three sections in the activity part of a cash flow statement. And then at the bottom here, it's a reconciliation of my change in cash, my beginning cash, and then my ending cash. Okay. So like I said, with the balance sheet, you want to make sure your beginning and ending cash match your balance sheet. So at the end of 12/31/23, my balance sheet better show that as well. Okay. And then I'm properly done my cash flow statement. Okay. So explain a little bit about how to read a cash flow statement. You first start up here with your net income. So my net income in my specific company that we're working with here is an accrual basis profit and loss, accrual basis accounting books. So this net income or loss includes bills that I haven't paid yet, and includes accounts receivable invoices I haven't received payment on yet, and all sorts of different changes that I'll go through here. So this is an accrual basis net income or loss. Okay.
And it's pretty rare for companies to be on a cash basis accounting nowadays, right?
It really is. I mean, like I said, if you want that full picture, you really do want to be accrual basis. Also, if you're a decent size, you kind of are required at some points to be on accrual basis accounting. So So anyway, yes, accrual basis is definitely gives you that better picture.
But if we're looking at maybe making some investments in the company that are going to require a cash outlay and things like that, I imagine that this statement's pretty important.
Yeah, so this is a historical cash flow statement. So this is going to report my cash flow for a period of time that already has existed.
Okay.
So when you look at a balance sheet, it's a snapshot in time. When you look at a profit and loss, it's activity over a period of time. So there's snapshots and then there's periods of time. Cash flow statement is going over that that period of time. Now, when you're looking at investing in some future, potential buying a building, or maybe you're going to invest your money in, in pure investments, you will want to look out in the future of what my cash flow is going to do. So cash flow forecasting is a whole nother avenue where you're going to take my snapshot in time and go forward. So this is a historical cash flow statement. Cash flow forecasting we'll cover and do another webinar on that as well. So
awesome.
Okay. So basically, when you're reading this, again, the net income losses accrual, the top part here, most companies have depreciation or amortization. If you know a little bit about what that means, it is not a cash outlay, meaning I don't write a check for depreciation. It's just a part of an accounting valuation where I'm going to take a chunk of my assets over time and value them down. Just like when you buy a vehicle, right?
Yeah,
right when you drive it off the lot, it goes down in value. Yeah.
Or you buy a piece of equipment and those sorts of things, you're going to depreciate that asset over a period of time.
Yep, correct. Yep. So basically, the top part there is you're going to have usually some sort of depreciation. If you have a gain loss on your assets when you sell them, you'll have that up here as well. Okay. This next section, my change in my operating and assets and liabilities. So this is going to be my accounts receivable, my accounts payable, my current assets, current liabilities, kind of think of it that way, my accruals, things like that are in that current part of your balance sheet. You're not going to be long-term assets, like if you have a long-term note receivable or fixed assets, that's down below. This is more your current assets and liabilities. So the change in net accounts receivable, what that means here is basically you have collections and you have invoicing. So if you're invoicing and your collections, usually there's a difference. They're not going to net out to zero there. If you receive more cash in the door than you invoiced out to customers in this time period, your accounts receivable will create a positive cash situation for you. So I've collected more than I've invoiced. Okay. Now, if you have a heavy billing month, if you are collecting and your receivables are in a good position where they're not aged very, long, like over 60 days, right? That doesn't necessarily mean a negative number here does not mean a bad thing all the time. I've just invoiced more than I collected in that time frame. Okay. So it's not always a bad thing. Okay. Changes to accounts payable, same thing. If I pay more bills out the door than bills come in the door, then I have a negative situation. So think about a company where they might not pay their bills very timely, right? Their cash is going to be higher in that time frame because they haven't paid the vendors yet. Right. So you kind of just have to think of it in those terms. So
makes sense
when you're looking at these numbers. Yeah. Now, accruals, same thing. Like if I accrue property taxes but haven't paid them yet, it's going to be a positive number. Once I pay those property taxes, it's going to be a negative number. So negatives are cash outlays, positives are cash inflows. So think of it that way. Okay. Perfect. Just basically that's this whole section. So if I've accrued more than I've paid out, it's positive. And if I've paid, and then the opposite situation there for the negative. Okay. So let's go down here to operating activities. So investing activities. So investing activities are going to be, I've bought some equipment. I've invested in stocks. I have some, long-term assets that I'm purchasing, right? So when you expend money to buy a piece of equipment, it's a negative, right? I've spent money to buy something. So that would be a purchase situation, this furniture and fixtures. If it's a positive number, that usually means that I've sold something because I'm getting cash in the door for a piece of equipment. Okay. So you kind of try to think of it in layman's terms when you're reading a cash flow statement, of negative is cash out, positive is cash in. Okay. So down here, paid some debt, right? So cash out, but my loan went down on my balance sheet. So good thing if you're trying to pay debt down that has a high interest rate, right? So maybe you purposefully spent $3 million here to pay some debt down and your cash went way down, but that's not necessarily, again, a bad thing. So it's just painting a picture of what you did. But like I've stated a few times, it is a historical statement and it's just a picture. So I like to put notes on my financial statements of, situations like that, paid down debt due to refinance, going to pay my line of credit down, So anyway, it's very helpful to put a story behind statements as well. So.
Right. Puts a little bit more context for somebody who's maybe not familiar with the report or maybe not familiar with the day-to-day activities, right? Yeah,
like owners like to see, notes. They might like, why is my cash so down? Well, hey, remember we paid the line of credit this month. They're in the selling mode. They're in the, running the company mode, right? Some of these owners. So when they see their cash go down, usually it's a red flag for them. But hey, remember we talked about we're paying this down and we're getting cheaper debt next month, right? So, Okay. So basically, that is the gist of a cash flow statement. You want to make sure, like I said, your cash agrees to your balance sheet. So see my 4.774, and then my beginning, because this is last year. So those agree. So I'm in a good spot. My cash flow reconciles to my balance sheet, and a good report group. Like I said, you want to give your balance sheet, your cash flow, and your income statement out all together.
Awesome. Well, thanks so much, Lisa. I appreciate you taking the time to walk us through what a cash flow statement is. If you're looking for more Construction 101 or Construction Accounting 101 videos, please follow the series. Make sure you hit the like and subscribe button here, and we hope to see you on the next one. Thanks so much.
Thank you.